Welcome everybody to today's deep dive. The subject today is using your financial statements to grow business success. Excited to be here. As always, let me give you a little introduction about myself. My name is Tyler Oliverson. I am one of the tax professionals here at Mazuma. I've been in public accounting for about 20 years. So enjoy working with small businesses especially. Now let's go ahead and just jump in. We will have a Q&A, a question and answer period at the end. Let me go ahead and get through a little bit of a short presentation here, and then we'll jump into that question and answer portion towards the end. So let's go ahead and get started. Tried to make this a little bit fun. It's not moving. Oh, there we go. Now is this, I've got a little, that right there. Does that show up on their screen? Oh, it's gone. All right. So as an accountant, I am a big fan of Shark Tank, right? You've got these super excited little business owners. They're in front of these billionaires pitching their fledgling little businesses. They make their presentation. Sometimes they're just sweating. I've heard that the lights are really hot, whatever it might be. They're nervous. They're on national TV. They hand out samples. They listen to praise or criticism. And then they hear, tell us about the numbers. Usually this is Mr. Wonderful, right? If you've seen the Kevin O'Leary, one of the, I don't know, he touts himself, very smart man. He says, that's all fine and great, but let's talk about the numbers, right? And then some of these poor little entrepreneurs, some of them just rattle things off. They know their numbers. They know their revenues. They know their net income. They know their year over year differences, their gross margins, everything. But others stand there, right? Deer in the headlights, fumbling around, pausing, I'm not sure, right? And the latter group ends up getting skewered by Mr. Wonderful, right? Usually there's this pretty curt little response. How can you run a business without knowing the numbers, right? I run my business offhand. I just run it based on what's in the bank account type of thing, and not the responses you want to have while on national TV in front of these billionaire investors, right? Sharks or not. So what we want to do today is I want to introduce you at a pretty basic level to two of the financial statements that you can use to help know your numbers, right? And knowing your numbers helps you make some financial decisions regarding your business. First of all, we're going to take a look at the income statement. Okay, let me give you a little bit of an introduction. The income statement reports a business's revenues and expenses during a specific period of time. So with the income statement, there's a beginning and an end date, and it's all the transactional detail in between those two dates. The income statement, for the most part, has two large sections. The first is the revenue section, and these are the receipts of the business generated by the primary operations of the business. Okay, so this would be sales or service revenues. It would not include proceeds from a loan or contributions made by the business owner. So these are revenues from the operations of the business. The second section is the expense section, right? And these are the costs associated with operating the business. Okay. Now there is a simple little equation, right? Revenues minus expenses equal net income. Okay. And I've got some examples, an income statement. We're going to take a look at it, and we're going to actually look at a comparative from the year to year type of thing here. And so let's just take a quick look at what a financial statement looks like, or at least the income statement, what it looks like. Okay. So here is a mock-up of an income statement for last year, right? As you can see, I've got from January 1st. Oh, I've got a comparative one as well. So this is supposed to be January 1st, 2020 to December 31st, 2020. Okay. So that's going to be a 1-year financial statement or 1-year income statement. And if we drop down, we can see some of the basic components of the income statement. We've got our sales. So I chose for this example, it's what would be similar to it, like not a retail, right? This is actually a small manufacturer here. So we're going to have sales. That's where we're generating our revenues from. So we've got our sales total number. If we were to look at what's called the general ledger, okay, which we're not really going to go over today, it shows all the transactional detail that make up this almost $64,000 in sales revenues. Now, since I chose a manufacturer, a retailer would have this as well. Usually, we're going to have our next largest item, or our cost of goods sold. Okay, it tends to be a large expense item. And let me tell you something about accountants. We're not very clever. Okay, when we name things, we're just pretty uncreative. This is exactly what it says. It's the cost to the business owner or to the business of the goods sold by the business. Okay. So this business acquired or manufactured goods at the cost of about $19,000 and then sold them for $64,000. Okay. Sales minus cost of goods sold is what gives us the gross profit. Okay, as we can see, we had about $45,000 in gross profit here. Now, if you're a service business, you're not going to have cost of goods sold, right? And actually, if you're using what's called the accounting method or the cash basis method of accounting, oftentimes we would actually include the cost of goods sold down in the supplies. Okay. I've separated them out for demonstration here. I like it for what I want to do here in a moment. Now, and then we get into the operating expenses of the business, right? Bank fees. Okay, I got to have my bank accounts, and banks charge businesses for bank accounts generally. You may have some other fees in there associated with maintaining a bank or a bank account, right? I got uniforms and clothing in here. And the reason that we've actually got anything in this is if it's a manufacturer, maybe they have some protective clothing, right? That would be deductible. Licenses and fees, you can see down here, we've got a postage. Okay. So this manufacturer mails all of their stuff out. They ship it. Okay. We have rent. I chose a food manufacturer. That's what this play on. This is here. It's a food manufacturer. So what we've got here is we've got like an industrial kitchen, okay, that they're renting in this case. And then we move on. We've got some supplies, little knick-knack, maybe some small utensils or small appliances that would go into there. Telephone. These are all things that we would normally have in the operation of a business. We got to market the business, however that's done, whether it's done through ads on the internet or business cards, maybe hiring a marketing agency to help run a little campaign, whatever that might be. Office expenses, everybody's got office expenses, even in industry, even a food processor, got to have a computer, right? They got to process their orders, do all their administrative work, whatever that might be. Professional fees. This is legal and professional, whatever that might be. And then we add up all of the expenses together and we get our total expenses. Again, we're not very creative as accountants as far as naming things. Expense totals, right? Great. We subtract that from our gross profit, and that gives us what's called our net income. Oftentimes when somebody comes in, we have a little bit of training to do on just semantics, right? Definitions. Revenues are top line. Typically, when we talk about income, We're not talking about what's coming into the business. I know that's incoming, right? But income is generally our net income. It's what we're left with after expenses. Okay. So this is a pretty good example of what just a basic income statement is going to look like. Now, I'm going to stretch this out just a little bit. And let's take a look at what we would call a comparative income statement, or a year-over-year comparative income statement, okay? And I have another one queued up here. The numbers on the 2020 numbers are the same from the last one, okay? Now what I've got here is I've got a 2019 year compared to a 2020 year, okay? And what I'm doing here is I want to use my income statement year-over-year comparable to see if there are any trends going on in the business, good trends or bad trends. Okay. This is going to help me know and understand more in depth as to what's going on in my business. If we look at this, we can see that my sales number went up. Yay, right? My sales increased by about $25,000. Okay, that's great. I didn't work the percentage on this one. I guess I could have to see what my percentage increase was. But that's something you could look at it as well, right? What is my increase year over year? That would be about 64 minus 39. So what's that? About 25,000 divided by 39. I don't know what that is. A little over 60% or ish, right around there. Year over year increase in sales. Great. Okay. Now I look at my cost of goods sold. Now we have a couple of types of expenses as well when we look at the income statement or in businesses. One's called a fixed expense, and the other one is a variable expense. Okay. A fixed expense stays pretty much the same regardless of any change in sales. Okay. Where a variable expense is going to change with sales. Okay. As our sales revenues go up, we would expect certain expenses to increase. For example, cost of goods sold, right? So we can see that here. It increased. We can look down. We would expect postage to go up. I'm shipping more, right? I'm mailing more out. These are probably small items. That's what I chose. Small items being mailed out on a regular basis. Okay. We would expect our shipping or our postage to increase with the amount of sales. Okay. That's a good thing. As you notice here, I've got rent actually decreased. And this is something that I want to talk about here in a minute, but rent would typically be a fixed expense. Rent doesn't change. For most people, it does not change based on sales. Although your lease can be a lease that, in retail, a lot of times you'll actually find that where your rent changes as a factor of your sales. But for most people, rent is going to be a fixed cost. Okay. My marketing went up. Maybe I had a little marketing campaign help generate some of these sales, right? And then everything else, it's pretty close. It remains pretty consistent except for my travel. Why is my travel down in 2020? COVID, right? Nobody traveled in 2020. Okay, so that would be somewhat to be expected. And then we can see in the prior year, probably first full year of operations, had a little bit of a loss. Not unusual, especially in a small manufacturer, right? You got to get your name out there and get going. And so we would expect to see that. Now, let's look at a couple of things that this comparative year-over-year income statement is telling us. And let's run a couple of things here as we get in. I wanted to actually run, if I could, really quick a projection. This is something that you ought to be doing in business, right? Get into your numbers. Once we know the numbers, what we've been making, or as far as revenues, we know what our expenses are. We've got accurate accounting records. Now we can get in and we can do some things that are, I don't know if you want to call them fun or not, but we can do some things. And what I'm going to do here is I'm going to say, okay, let me see what percentage of my cost of goods sold, what percentage of my sales, this is is my cost of goods sold, and see if I'm improving, right? Because there's two really kind of main ways to increase profitability. One is to decrease expenses, right? And that's actually why I put in here the way that the rent works down here, is because what I did was in my example here, the business was paying $2,400 a month to a commercial kitchen, right, as rent. Well, maybe they were able to either find a new commercial kitchen or renegotiate their lease going forward. And now they're only paying, I think I put in here like $1,750 a month. And so they were able to bring their costs down. But here's one that's maybe not as easily noticed. If I do this, why is that not? Doesn't want to give me an equal. Keyboard not wanting to work here. No, Well, isn't that funny? Okay. Anyway, we'll move on. What I've got here is I'm saying, hey, look, I wanted to look at the cost of good as a percentage of sales, right? This is one of the ratios that we like to use in accounting. We say, okay, if I divide my cost of goods sold by my sales, I come up with a ratio, and that's going to be, I don't know, right around 35% or so, let's say. Well, this year, it's actually quite a bit lower. It's less than 30%, or right around 30%. And so as you know, as you're going, you're able to say, hey, look, I'm going to go ahead and maybe with an increase in production, I'm able to do some bulk buying. I'm able to negotiate some of the costs of my product. Therefore, decreasing my costs. A decrease in cost is going to result in an increase in net income at the bottom. Just like saving $7,800 in rent, you know, that's a direct increase to my net income at the bottom of at the end of the year. Now, you could do that with cost of goods, anything. We don't want to just willy-nilly not pay for something, right? We still got to have supplies, but if we can do anything, that helps. And then the other thing that we can do, and this was a hard lesson learned for me. This was a hard lesson learned for me when I first went out into business on my own as a sole proprietor accountant. Man, I thought, man, if I can get out and I can charge X dollars an hour for my work, and I'm able to work 40 hours a week through the year and then 65 hours a week during tax season, man, I'm going to make a lot of money. That was my thought, right? And I thought, okay, I can go ahead and do that, and I'm going to be set, right? Well, what I found was, one, the rate that I first put out there for my services, I didn't take into consideration all the administrative work that I was going to be doing, right? And so it was extremely difficult to even come close to 40 hours of billable time in a week. And then I undercut myself. I didn't value my service fully. And that was one of the things that I really, really learned kind of the hard way when I first went out. So we can cut expenses to increase profit, but then again, we can also increase our revenues. We can go out and we can sell more. That's what's happened here, right? They went out and sold more product. Maybe they had a price increase on their product. Maybe their product was more valuable than what they had initially priced their product at, or your service, right? Don't undercut yourself. You're valuable. Make sure that you're billing what your value is. Okay. Maybe it's a factor of getting not only more marketing, but the right kind of marketing, right? To get your name out, market through your current customers. I didn't do that very well. I just wasn't a great marketer. Learn those lessons. learned how to value my service and my expertise, and then also learned how to market through other people. Okay. So let's go ahead and move on. Let's go ahead and move on to the next financial statement that we oftentimes use in business, and that would be, I guess I can play it either way. The balance sheet. Okay. And really, for small businesses, the balance sheet oftentimes gets ignored. And I'm going to encourage you not to ignore your balance sheet. Balance sheets can be very, very important. They're not as glamorous, right? Because it doesn't show what my net income is. But balance sheets are important. So here's what a balance sheet is. A balance sheet reports the company's assets, liabilities, and equity at a specific point in time, right? Year to date, right now. What are my assets, liabilities, and my equity? So assets are resources with economic value owned by the business, right? Liabilities are things the company owes to someone else. And equity is the value of the business to the owners. Now, we really need to be careful because value can have a lot of different meanings. What we're going to use it here is simply what would be left over after all the liabilities are paid. Okay. Most often on a really good business, the value of the business is more than what's left over if you were to pay your assets, right? There's things like goodwill and reputation and other things in there that are actually very, very valuable. So there is an equation here as well. Assets minus liabilities equal owner's equity. So here's an example of the balance sheet for the company that I had previously on here. Now let's look. So we've got the assets of the company, right? We've got what are called current assets. These are assets that can be used up, or we expect to be used up on a continuous basis, right? Any money in the bank's not going to sit there for a long time. It's going to go out either as to pay an expense or make a distribution, and then new money's coming back in, right? So we actually have our bank accounts as current assets, okay? I even have a fixed asset in here. This is an asset that has a long life, more than a year, okay? My company is a candy company, and they went out and bought a chocolate tempering machine for $14,000. Okay. That is something that is of value to the business. And that's going to be deducted over time through what's called depreciation. Okay. So we add up all of our assets and we come to right around $39,000 in assets. Okay. Now we have liabilities. In this case, we don't have a lot of liabilities, right? We've got a couple of credit cards, it looks like. And most likely these credit cards are being paid off on a fairly regular basis. Okay. Now, could there be a loan? Maybe if they finance the tempering machine, there could be a loan in here. In my example, it was paid for by cash out of the company. Okay. Now we get down into the equity section. All right. The equity section is generally comprised of three things for most small businesses. We have contributions. So this business owner has put in $48,000 of their own money. Okay. And it can be a combination of many different people, right? If there's more than one owner. In my example, I've just got one owner. They put in $48,000. Whether that was all up front or over the period of time that they've owned the company, doesn't really matter. It's contributions year total, all the way up until this point, how much has been contributed, okay? That is, in essence, kind of a credit to the business owner as far as value is concerned. The other thing that we don't have in here that sometimes we'll see are called distributions, right? If there's earnings of the business, the owner has the right to distribute those earnings out to themselves. And then we've got retained earnings. Now, the retained earnings is the accumulation of net income over the life of the time that we've had the business. Okay. And there's a few different ways to present these. This is how I've chosen to present these today. And in our case, since we had, if we look back at our income statement, right, we had a big loss in year one, and we had a little bit of income in year two. Well, those put together give me my retained earnings. Okay. And retained earnings is a subtraction, in this case, from contributions. If my retained earnings were positive, would be an addition to. And then we can see here, right? My assets, my total assets equals my total liabilities and owner's equity. It's called the balance sheet. Again, we're not very creative. It balances, right? The assets equal, it's like a little, I don't know, scale. Okay. And they balance and they equal to each other. Now here's something about the balance sheet that's very, very important. The balance sheet, the income statement can tell us whether we're for accounting purposes having net income or a net loss, right? But the balance sheet is going to give us really the health of the business. You can be profitable but still go out of business. Okay. Again, you can be profitable but still go out of business. I've created a balance sheet here that is a healthy balance sheet, right? We've got assets, we've got cash on hand, we've got an asset, in this case, a tempering machine. We do have debt and liabilities, but not a lot, right? If I were to move this $48,000 up into the liabilities, we could see that, oh my goodness, maybe we're not in as good a shape as we thought we were, right? Because the company owes $48,000 to an outside creditor. And if we're not profitable enough to make our debt obligations and return a rate of return to our investors, we're going out of business. Okay. So we look at the balance sheet, and this gives us an idea of how healthy the business is. And this one is a healthy business. Okay. We've got equity. Our equity is not negative. It can be. Okay. And it can be if we're using debt to finance the business, right? There's a few ways to finance a business. We can go get debt, right? We can finance our operations through debt. A lot of people did that last year with all the shutdowns through COVID. Okay. We can contribute as owners to the business. That's a way to do it. And then we can fund the business, the operations of the business, right? Through its net income. As we have net income, more money's coming in than what's going out as far as expenses and maybe debt obligations. And we're funding the entire operation or the entire business through its operations. Preferable, that's where we need to get to as business owners, right? So that's a little bit of an introduction to the income statement and to the balance sheet.